How much more risky is Zilliqa versus Bitcoin? That's the question of this video. I've done a quantitative approach over here. I've made a back test on this, looking at Zilliqa's daily price movements versus Bitcoin's daily price movements. And we determined something called the beta of Zilliqa. So I've done a tutorial on how to determine this. That's usually content for the premium members, but for this time, I'm publishing this here on the YouTube channel. So I hope you enjoy the content. Welcome to another premium tutorial. In this tutorial, we are going to discuss the inherent risk of Zilliqa versus Bitcoin, as in how much more volatile is it? Because just by observation, we can see when we look at the top to bottom over here, this is a quite drastic drop, right? More than 98%. We've never seen a drop like this in Bitcoin. And the same goes true for the other way around, right? When we have bullish times, a gain like this cannot be seen in Bitcoin. So we want to find out how much more risky is Zilliqa actually, at least on average. So instead of buying Zilliqa, you could also buy Bitcoin on leverage, right? You could just buy it maybe with a 3x leverage and get potentially something similar. So the reason why this question is important is because when we construct a portfolio, we want to know how much more risk are we inviting into the portfolio, right? When we say have 1,000 US in Bitcoin and we then buy 1,000 US in Zilliqa, suddenly our price movements are way more pronounced. But if we want to have, say, the same kind of price risk in Zilliqa as in Bitcoin, then we would have to buy less Zilliqa. But how much less, right? That's not really quantified. And in this video, we are going to quantify this. How much more risk are you inviting? What's the inherent leverage? Or in financial terms, we say, what's the beta? Okay. And as a benchmark, we use Bitcoin here. You could use something else as benchmark as well, right? You could use Ethereum. You could use total 3. So how much more risky is Zilliqa versus other altcoins? You could also use the stock market, right? The S&P 500. Say when you move money from the stock market to crypto, how much more risk are you then inviting into your portfolio by converting that money to something like Zilliqa? And so let's first of all download the price data. I have done recently a video here where you can get free data. So when you're looking for daily returns, which we will be working with here in this tutorial, if you just need daily returns, you can just download this here on CoinGecko, just following the process here. It's a 5-minute video. It's pretty straightforward. I find it a bit more user-friendly, a bit more convenient to use TradingView. Sometimes the time series on CoinGecko is a bit longer. And here for TradingView, you also have to pay in order to have this download feature. So do whatever you prefer. So we've downloaded now the time series. Let's open up Excel and let's drag and drop these CSV files into Microsoft Excel. What's important is when you download this, that you get this from the same exchange and from the same trading pair, right? So here I used Huobi because this was the longest time series for Zilliqa together with Tether, right? So Zilliqa versus Tether on Huobi. Then I have to take the same time series here for Bitcoin because otherwise we introduce just an additional layer of potential inaccuracies, right? And we want to be as accurate as we possibly can. So first of all, I take the Zilliqa time series, right? And I copy paste the time over here. And then I do the same for the price. The closing prices are here in column E. Copy paste this over here, name this Zilliqa. Now, why did I start with Zilliqa? Because the time series for Zilliqa that I get here are shorter than for my benchmark. This is usually the case. And so we want to now find the place in our benchmark data, in our Bitcoin data, where the Zilliqa price history starts. So the Zilliqa price history starts over here. So I copy paste this timestamp and then I search for that here within the Bitcoin price data. So this is where the Bitcoin price data starts. So I will now copy paste those closing prices from this line all the way to the bottom and do this here, paste. So this is Bitcoin, okay? Now we scroll down and see, do we have actually the same length of data? That's correct. If that's not the case, then this is definitely a red flag. You've got different amounts of data for the different assets. This can happen, for example, when you compare crypto to stocks, right? Because stocks, they might only be open 5 days a week. Crypto is open all the time. So then you have to do some cleanup work if you still want to use daily data. Otherwise, you might just revert back to weekly data. So those are the prices. Let's now calculate the daily returns for this in order to find out the leverage. So what's the daily return? It's simply just dividing those values, right? And and then subtracting 1 from this, format this as percentage. Can also add maybe 1 decimal to make this a bit nicer. And in here, label this correctly so that we've got the returns here. Copy paste this all the way down. And now we've got a time series where we've got both the Bitcoin return and the Zilliqa return next to each other. And so the next thing is pretty straightforward. It's simply just inserting a scatter plot. So you click over here, you add a scatter plot, and now you see something that already shows you the correlation of the two assets. So because these points, they somewhat go in this positive sloped line, we can see when one asset tends to go up, the other asset tends to go up as well, and vice versa. Now, in this particular example, because we have just highlighted the cells over here and Zilliqa comes first, because we've done that, we now have Zilliqa on the x-axis. But usually in these kinds of charts, what's most common is to actually put the benchmark on the y-axis. And I will show you later why. So let's delete this again. Let's move this around and let's have Bitcoin first. Okay? And let's again highlight all of this and insert our scatter plot. So it's the same thing, but this time we've got Zilliqa on the y-axis and Bitcoin on the x-axis. So the idea here is that each single day here, each single point represents a day. So at a certain point in time, we had one day where Bitcoin went up by 15.8% and Zilliqa went up by 36.3%. Okay, so in this particular example, for this particular point, Zilliqa was a bit more than 2 times as reactive as Bitcoin, right? It had more of a rally. But we want to know what's actually happening here on average with this. Let's maybe format this a little nicer. I'm personally not really a fan of this glow effect, so let's take that away. And let's also change the color over here. Okay, so the first thing that we want to do is we want to add a trend line over here. Now, what's this trend line? This is a logarithmic regression line. Let's make this a bit more visible, maybe in white, remove all of this fancy transparency. And what this regression line does is minimizes the squared distance from this representation, from this linear representation. It tries to represent the data as cleanly as possible. So if you had to predict where would one value be given another value, this is your best estimate. And so in order to get now the inherent leverage, we simply have to divide the value on the y-axis to the value on the x-axis. So let's maybe do this a bit in detail. Let's maybe zoom in over here. Let's put the maximum to 10%, the minimum to minus 10%. So we're now zooming in that chart. And let's also do maybe 0.5% increments for our x-axis. And let's do the same here for the y-axis. So we format this here, go from minus 10% to plus 10% with 0.5% of increments. Okay, so now when we look at this, when we are at a 10% move for Zilliqa, we are at a move of, this is 9%, this is 8.5%, okay? So roughly 10 divided by 8.5 is our leverage in Zilliqa, which means 1.176x. So you can toy around a little bit with this format, with this formatting of the axes. Microsoft Excel is not the most convenient tool for this, but the results in the end are pretty much the same, right? Depending on, it's independent on what kind of settings you do for the axis. The relationship is the same between those numbers because this is simply just a line, right? We just need to get the slope of that line. So 1.176x is not that much. Now, why do we then see these massive moves? It's because of the outliers. We sometimes get days that are strong outliers. And another thing we want to look at is something called the alpha. So with the 1.176, we got our beta, right? But what's also interesting is to get to know how much is Zilliqa outperforming given that Bitcoin doesn't move at all. And for this, we have to go really, really deep here on the zoom. So let's maybe go between plus and minus 2%. Do this for both axes and look at an increment of 0.1%. So what we have over here is now the point where this line is crossing the y-axis. Now, it's not crossing it at exactly 0, right? It has a bit of a positive cross here. And if we zoom in a bit more even, you can probably see this even better. So the cross seems to happen, let's adjust here the decimal places. The cross seems to happen at around 0.13% maybe. Okay, so 0.13%, that's our daily alpha. So the idea is when Bitcoin isn't moving at all, Zilliqa is still making money. Zilliqa has an alpha. At least that's what happened in the past, right? We can't really know if this happened in the future. But even risk adjusted, Zilliqa made more money than Bitcoin. That's the overall idea. If we adjust for our 1.176 inherent leverage, still Zilliqa made more. And the return is daily 0.13%. Now, how much is this per year? We simply take this value, we add 1 to this, then we get a factor over here. So that factor is 1.0013. And then we take this to the power of a year, right? 365. And then again, we subtract 1 from this, show this as a percentage, and then we get the annualized alpha. So in other words, if Bitcoin isn't moving at all, Zilliqa is expected to increase by 61%. Or another way to look at this is, say Bitcoin would be going down by like 50% or so. If Zilliqa's positive momentum can stay as positive, it wouldn't move by that much. So let's say we are down by 50% in BTC. Okay, so this is our BTC loss. Then our Zilliqa loss should be this times the beta, right? So that would be the Zilliqa loss. But since we have an annualized alpha of 61%, we would actually be more or less plus minus 0 with Zilliqa. Now, will this really happen in practice if Bitcoin really loses half of its value, that Zilliqa will be completely untouched from this? Very hard to say, right? There is correlation in crypto land, and these numbers, they do change with price changes. So the alpha that we calculated when we take away maybe this recent rally over here would probably be quite different. Actually, let's do this. Why not? Let's play around with this and see how sensitive this is. Let's move this out and take away the recent rally and see how our alpha is actually affected. So let's take away everything after, say, 4.5 cents. So that's just these last few days. Let's take that away and get our alpha. And there we go. That's the difference. So maybe move this down. Let's remove these days. So without that recent rally, our alpha would still be positive, but it's much, much less, right? It's maybe 0.1% or so. So 0.01%. So that's how sensitive this approach is. The idea, the general idea of this, I think, is useful as in a general gauge for especially the beta, because the beta is more stable, doesn't move as much. So for assessing risk of an altcoin versus the overall market, I think this is useful. For alpha though, as in how much is it outperforming post-adjustment for risk, this is obviously quite sensitive. Just a single rally in this entire time series moves this around massively. So even though it's an interesting idea, and even though a lot of people talk about this, most people probably don't even know what alpha means in financial terms, right? They just say, okay, one asset performs more than the other, here is your alpha. But what alpha actually means is that you get outperformance even if you adjust for risk. And we can determine this over here, but as said, this can change overnight, right? If you've got positive or negative alpha, can change overnight. The volatility of an asset doesn't change as much. The inherent leverage of an asset doesn't change as much. So I find this quite interesting for Zilliqa. If you compare the inherent leverage of other popular altcoins of similar size, let's say, for example, Phantom or so, we see way more inherent leverage. Phantom has an inherent leverage of 3 versus Bitcoin. Ethereum's inherent leverage is also pretty high. If we have now Zilliqa here with 1.17, Ethereum's beta is 1.1 versus Bitcoin. So what can we take from this? When we analyze Zilliqa, when we want to time the Zilliqa market, the overall movements in Bitcoin are probably not going to be too much of an influence. Bitcoin doesn't really move the Zilliqa price that much. The beta is low. We really have a lot of idiosyncratic movements over here. So it does make sense to analyze Zilliqa more or less in isolation. For most altcoins, you really want to look at the overall market and not be invested when Bitcoin or Ethereum tends to trend down. The data suggests that this is not necessarily something that's as important for Zilliqa. This tutorial and many more can be found with the premium membership, so feel free to check that out. Link is in the video description. You can sign up either monthly, it's currently $49 US per month, or alternatively you can sign up for the entire year where you get 2 months for free. I continue to publish free content here on YouTube, so if you enjoyed this, don't forget to subscribe. And last but not least, you don't want to miss out the moving average backtest that I've done. I've simulated buying and selling Zilliqa based on the moving average. It's one of my most popular videos on this channel, so don't miss it. There's a lot of value over there. See you in that video, and thanks for watching this one. Bye bye.